A $1 trillion company is asking for $80 billion from stock sales to fund more AI infrastructure. They're using this money to invest in AI because they have so much backlog that they can't keep up with the demand. And not only that, they did mention that for the 4 year in 2026, they're going to spend as much as $190 billion. And they did say in 2027, this might increase significantly. That does not sound good to me, but at least it's for a good reason. Google just crossed about $462 billion in backlog. What this means is that customers paid or are ready to pay about $462 billion for their AI services. That includes cloud, which is up 63%, and they have so much demand that they cannot keep up. So they want to invest all this money to have all the data centers ready, all the chips ready, to be able to provide a solution or a product to the customers that have all this money piled up waiting for Google services. Now, Google has to do this, and I understand why they want to spend the $80 billion, because if they don't do that for these customers, they'll just go over to Amazon, to Apple, to Microsoft, to whoever is making these investments in the huge data center. Now, as you can see on this chart here, over time since 2021 now throughout the end of 2025, Google has been increasing its cloud operating revenue along with its cloud operating income. So I want to take a look at Google's intrinsic value and see if it would be a good investment to add this company to our portfolio, since the stock dropped about 3 to 4% after these news. Now keep in mind, this is just an average of the intrinsic value. We're going to be taking a look at 3 cases. We're going to look at a base case, a bull case, and a bear case later on in the video. But as you can see throughout history, this gray line here is the intrinsic value, and then if the line is green at the bottom, it means the stock was overvalued. If it's red like it is now on the top, it means the stock is overvalued. So let's go ahead and take a look at some financial data. Now if we compare Google's price to the EPS, we can see that the price has been following the EPS. The more the EPS increased, so did the price, except around this time here, which was when everybody was saying that Google was going to get killed by AI. Nobody was investing in it. This is where I initially invested in the company, but I did exit out of it. But now it's starting to look like the same is happening with all this AI spend. The price is trying to come back down again. Their EPS is increasing, so I'm eager to know what will happen in the future in the next earnings report. Now, of course, something that investors don't like is that the free cash flow is declining due to all of the investors they're making, but this is normal in Google. As you can see, it has waves of up and down on the free cash flow because this is a compounding machine. The more they invest, the more money they make. And then we're starting to see the same thing for the revenue. It has been increasing steady over time. It has some jumps down like here, and now it's starting to happen again. So it gets me interested to see if I'm able to buy back in this company, but we have to look at more metrics. If we take a look at the financial, this company is absolute giant. Revenue at 400 billion, up 15%. EPS is up 34%. Their operating cash flow is up 160 billion, which is 31%, and so on. Now, Google, with it being such a huge company, of course, they were a lot more into software than they were into infrastructure. This is why they have 700 billion in assets and only 225 billion in liabilities. This will most likely change with all the investments that they're making in data centers. And this is the overall company efficiency. As you can see, they have a gross margin of 60%. The return on invested capital is declining a little bit due to, again, all the investments that they're making. The same thing for the return on capital employed. Now, even though the stock has been reaching all-time highs, there's still a buyback yield in this company. That means that the management team believes the stock is still a little bit undervalued, so they keep buying this stock back. However, if they're going to issue new shares to the market to raise that 80 billion in capital, which only 40 billion will be in actual shares, the rest is for some tax purposes, I wonder if they're going to stop doing this, because I'm sure they will figure it out that Wall Street is not going to like all the spend. The stock might drop more, so I'm waiting to see if they're going to stop this for now, wait for the stock to drop, and then buy more. If we take a look at a Wall Street rating for Google, we can see that it has a strong buy of 4.54 out of a 5 rating. That consists of 62 total analysts in the last 90 days. There's 41 strong buys, 14 buys, 7 holds with 0 sells and 0 strong sells. And again, this is a huge uptick in the cloud. Of course, Wall Street is not expecting this company to maintain these numbers. So in future earnings, it will go back to the 15-20% growth quarter over quarter that Google is expected to make, which is very healthy for a company this size. Now let's go ahead and take a look at the intrinsic value. If you want to take a look at metrics like this, there's going to be a link in the description below, but a base case scenario for the stock is that it could be worth $241. A bull case scenario is that the stock could be worth $373, and a bear case scenario is that the stock is overvalued at 61%, giving it a stock price of $141. But that's not it. Remember that when you're investing in this type of companies, or any company in general that you want to follow the intrinsic value, you should always have at least a 10 to 20% margin of safety. It just gives you that cushion to be wrong even more. That way, to potentially you could have a more profitable future. And in this case, for Google, if you want to buy it below a 20% intrinsic value on the average side, you will be buying the stock at about $193 with a margin of safety of 20%. Now, as you can see here from this company ticker, they have a price target of $609 with the current stock price being 385. So that's almost doubled, which is an increase of 10% year over year. And I want to ask you guys, do you think Google will start dropping in share price before it even goes up due to all the news? Wall Street's pretty much going to get scared. They're going to say it's too much spending. I think that would happen, which will bring an opportunity for me and other investors to buy this company. This is not financial advice, it's just my opinion. But I believe Google is 100% certain that AI is the way to go. That's why they're making all this investment. And with an even more reason, with all the backlog that they have, they definitely have to give the product or solution to the customers to maintain that customer base and in the future have more returns. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you in the next video.